Hello, it's Adil speaking, bringing you a review of the currency pairs now. I think I'll start with the Aussie and then I'll hopefully go on to the Kiwi and the Euro. Okay, so initially Aussie USD and where exactly is it headed in this week? And obviously, given the fact that we have Yellen testimony on Tuesday post the FOMC, which everybody's interpreting as being dovish. Now, whether her commentary confirms that, again, is a wild card. So the market could certainly move either way. Now, looking at the currency pair from an intermarket analysis perspective, which is my trading style, I'll start off with the dollar. Obviously, the US dollar is the most important and dictates the movements. Okay, so let's have a look at the US dollar on the daily chart first of all. Okay, as we already know, I've highlighted this on several occasions with regards to this bullish channel breaking out to the lower side, and as you can see here, we certainly have broken. We're consolidating now. Whether or not this is consolidation for another move higher, so either this could be a move higher if Miss Yellen confirms, or not confirms, but basically denies the dovish or casts doubt on the FOMC minutes in any way whatsoever, and confirms that she will continue with her rate hike cycle, because obviously it undermines her credibility if she has this mandate of obviously tapering, then relying on economic data, etc., etc. Now, last week the inflation data out of the US was very tepid. Okay, so it's a difficult one, even though the international developments are very negative, shall we say, in terms of the Greece saga. Now, last week when the FOMC minutes did come out, even though I don't believe that they're delayed, they're always adjusted to the last minute, and they fit based on geopolitics and socioeconomics. We had the uncertainty regarding Greece. Now, the last minutes of the FOMC minutes, the last thing the FOMC minutes wanted to state is that they are going to go ahead with obviously a rate hike cycle, and the last thing they wanted to do was obviously take out the patient terminology, and obviously take out the international situation terminology. Okay, so it was very important from my perspective how they stressed upon patience and international developments. International developments being what? Greece, as we all know. Okay, so the uncertainty regarding that, and obviously that can affect sentiment and so on and so forth, and patience as well to a large degree, because the economic data recently hasn't been that spectacular except jobs. Okay, and the inflation data really is not confirming the view that obviously if you are fighting deflation, because if the Euro group or the Eurozone is doing QE, we have Japan doing QE, they're exporting deflation. So where do you think deflation is going to go? It's a zero-sum game, so therefore it'll be America. Now we also have China now suffering from deflation as well, hence the reason why they did a rate cut. So the last thing the Yanks want to do now is obviously increase their interest rates, and it'll be an exponential move in the US dollar, which then will obviously, they will basically incorporate and absorb that deflation, and then they're in a sticky situation economically. So I mean, Yellen is in a real pickle, shall we say, a real conundrum. Basically, on the one hand, she has to raise rates because she has to protect her credibility and the mandate, obviously with the economic data with regards to jobs obviously improving as well, the unemployment rate dropping, the GDP data has come out somewhat weak. Okay, so one could argue that the economic data certainly isn't there. Then you have disagreement between the members within the FOMC. Some want to have a increase in interest rates because they don't want to fall behind the curve in terms when inflation starts to pick up, although she can fall back on lower commodity prices, obviously hurting inflation, so she can rely upon that. And then obviously she has Greece. So this week she has no Greece. Greece has signed a 4-month extension to the bailout, etc. S&P 500 has gone to new highs. Okay, so if you ask me, just from a reading from a market perspective and look at the S&P 500, I mean, if you look at the S&P 500 on a daily chart perspective, given the fact that the FOMC minutes dictated that the S&P would go to 2140, 2120, 2150, etc., given the fact that the Fed remains patient on interest rates. Interest rates are not going to rise, given the fact that QE is being done abroad, therefore it's lifting the US dollar, and that itself is a rate hike cycle. Okay, that itself is a rate rise. So she has that to contain as well. That's why she started to talk about the US dollar. Okay, and that's why you've seen the BOE. You actually had the BOE talk about concerns of a rising sterling. So every bank is playing the currency war game, whereas the US is being left behind. Okay, and everybody is exporting deflation. China is certainly taking a certain amount of it, but they still have the ability to cut rates. Okay, and the US really has run out of bullets basically, because they fire the QE1, QE2, QE3 bullet. They can't fire the interest rate cut bullet because it ruins their credibility and their mandate, and Yellen obviously has to maintain her credibility in terms of the tapering avenue that they've gone down. Okay, and now there's talk about interest rates going higher as well. So it's a real conundrum, and there's a lot of geopolitical, socio-economic variables at play. And for me to summarize it now and say this is going to happen, it's very hard for me to do. All I can say is that number one, the Greece situation is out of the equation now, so therefore she doesn't have to rely on international development, so use that as an excuse not to raise the interest rates. Excuse me. Then the next obviously episode is the actual inflation data, so that's what we'll be focused upon. So if we bring up last week, let's bring up last week's economic data and see if I can share this with you. Bear with me and just give you an insight. Okay. Right, so if I had to go to the economic data from last week, so let's see if I can filter this out for you. 1 second. So filter, all we need is this. Take out low, just the US. Bear with me. I mean, let's just take the economic data out of the US. Okay, so Tuesday, housing weaker. Okay. Wednesday, overall economic data, housing starts weaker, building permits weaker, industrial data weaker, so negative. Okay. Obviously with the FOMC minutes, so let's just ignore that for now. Thursday, continuing claims slightly increased. Initial jobless claims, jobless data was slightly weaker. Leading indicators weaker. US PMI data weaker. Let's go to the previous week. Okay, so we're looking at last 2 weeks now. Tuesday, 10th of Feb, wholesales data weaker. Auto sales, etc., weaker. We had jobless claims, retail sales, consumer confidence weaker. Go to the week prior to that, so we're looking at almost whole of Feb now. Personal income spending slightly better than expected. We had personal consumption expenditure more or less in line and slightly better. Manufacturing PMI in line. ISM weaker. ISM prices paid weaker, so that's what she's focusing on, real wages. Okay. Let's have a look at the ISM data overall. Initial jobless claims slightly weaker than expected, so that's good. Okay. The inflation data is the one that I'm really interested in. So here we go. Okay, so average weekly hours, okay, and hourly earnings is better than expected. So that's the figure that she's really focused on. Okay, it's inflation and obviously real wages and average hourly earnings. That's what she's focused on, because that's basically what's going to cause the actual inflation that focuses, that gives the ability, or gives her the mandate to raise rates, because that tells you that the consumer or can actually incorporate and certainly survive a rate rise, so to speak, because it's consumption that equates to almost 70 to 80% of GDP, and that's basically what needs to hold strong in order to absorb that rate rise. Okay, so that's basically the important factor. So as you can see here, if I look at the last 3 weeks, overall the economic data has been pretty weak, except jobs data. Okay, and it's jobs that will basically be the leading indicator. A real wages rising, okay, average hourly earnings, etc., rising. That's basically a real the important cog, because obviously if you have high disposable income and more jobs being created, that eventually leads to higher economic growth and activity and so on and so forth. So that the economic growth and activity is always lagging. The first thing that it has to be created is real wages and wage growth and jobs. Okay, so that's why she's looking at that and focusing on the rate hike cycle based on that information. Okay, she had international developments such as Greece, which as we know, so that's the reason why the FOMC minutes had to be tilted towards that direction. Now this week, when she comes and gives when she does actually attempt to give a commentary on those minutes, I expect a slight tilt towards the hawkish side, if not neutral. Okay, if she does sound dovish and she wants to reassure the markets and increase the confidence in the markets, and she wants the markets going higher, so for example she wants the S&P 500, she wants to create a buffer for herself, because that's what I would do as a central banker. I mean, would you rather raise rates here and allow the markets to go back lower, okay, and obviously you're basically hurting confidence, hurting sentiment, and so on and so forth, because the markets are no longer at new highs? Or would you allow the markets to make new highs, continue higher, okay, give them the feel good factor, i.e. remain dovish, okay, and then break the news and allow the S&P 500 to go back and retest the breakout level? That's the question you need to ask yourself, okay, and that's the question I'm asking myself as well. Or alternatively, she can break the news now and allow the markets to absorb it, so it goes back, consolidates, builds a base around the 20,000, and then eventually breaks higher, given the fact that you've got QE out of Europe, QE in Japan, easy monetary policy around the world, India starting to grow, okay, and basically what happens then is that the US, now that it's potentially raised interest rates, it has an extra bullet to fire. So when it does cut rates, if situation deteriorates, then she has a bargaining chip, okay? And given the fact that she claims that the wage growth is starting to rise, etc., etc., then even though we do have a retracement, then the economic activity, when it does pick up, will create a new high in the S&P 500 regardless, okay? But it's all about managing the reaction of an interest rate rise, and that's basically what she is in a real that's the biggest task basically for her, okay? That's the biggest task, and it's our job really to read between the lines and understand as to what's happening. Now if I were to look at my dollar chart alone, and if I were to ignore all fundamentals, the dollar chart is telling you that she is going to be dovish, yes, okay? It's blatantly telling you she's going to be dovish, because we've obviously created a resistance level here, and we broke out this bullish channel. So it's telling you either the market anticipates she's going to be dovish or maintain her dovish stance, given the Greece saga, etc., etc., and basically this is a situation that's going to occur, okay? So one would assume or presume that given the fact that the Greece saga is more or less been kicked down the road for 4 months, the euro now has the ability to move higher, sterling moves higher, etc. Risk currencies all start to move higher because they want to price in bullishness in terms of risk, and that obviously in turn JPY sells off, CHF sells off, US dollar sells off, because we don't have that social economic risk anymore, and obviously the markets sell off. Now again, it's all dependent upon what Miss Yellen has to say on Tuesday. If she maintains a neutral stance, leaves the market guessing, then we don't really move upwards or down, we just move sideways, and then obviously geopolitics will dictate. Now we do have developments in Turkey at the moment, okay, and we also have developments with the UK and Russia, with certain bombers obviously infringing on UK territory or almost near UK territory, so that's going to be an interesting development, okay, and the situation obviously in Ukraine and Russia, that obviously remains there as well. So there's a lot of interesting developments going on in terms of geopolitics, and that could break out anytime. I mean, you could get an exogenous variable shock. I mean, there could be, God forbid, anything were to happen, the dollar could spike regardless, okay? Again, the Greece situation remains very fragile. What if that breaks down at any minute? Again, the US dollar could catch a spike and the euro sells off quite hard, and risk assets, obviously risk currencies such as the Aussie and Kiwi, follow it lower, JPY, CHF move higher. So again, it's very hard for me to predict, but just looking at it from that perspective, okay, just in terms of fundamentals. So it's all dependent upon how Miss Yellen spins her web on the minutes, okay. But from my perspective, given the fact that she has to maintain her credibility and the economic data, although from a productivity and growth perspective isn't there, the wage side of the equation certainly is starting to pick up. So, and there are a lot of Fed members that don't want to fall behind the curve, and that's going to be very, very interesting from my perspective. Or alternatively, you could read the Greece news as remaining in the background. That would obviously cause the euro to fall, and in turn, that could obviously send the dollar higher. That's another situation. Or alternatively, you could read that the euro situation now is resolved. The euro starts to move higher, and the dollar will naturally fall anyway. Okay, so even though she is hawkish, the dollar will be falling regardless. So again, there's so many permutations and so many different ways in which we can read the market from a fundamental perspective. It just depends on prior to her speech, there could be several Fed members that come out and give us signals. Okay, so if they all start to be hawkish, then they're prepping the market for a hawkish speech. So it's your job to read between the lines and pick up on that news flow. Okay, right. Let's start by looking at the technical side of the equation now. Okay, so Aussie USD. Aussie USD is very interesting because the minutes, as of late, are indicating that the Australian bank is not as dovish as everybody expected. Okay, from their perspective anyway. Okay, so although the interest rate cut is certainly on the cards, and the economic data isn't exactly spectacular. Okay, that's the fundamental backdrop basically with regards to Australia. Now, if I just do the same filter again, so if I show filters here, so if I filter out Greece, Spain, UK, and let's just do the same thing with regards to the Aussie. Get rid of EMU, Germany, Japan, New Zealand, Portugal, Switzerland. Bear with me, just Australia, that's the one. So files of results, there we go. Bear with me. Right, okay. Right, this is not going to work on this one, is it? Okay, 1 second. Bear with me, just bringing this economic calendar, adjusting it in terms of economic data of the last week or so. Okay, so if I go to filter, what I'm doing here now is filtering out everything except the Aussie so that we can go over that. Apply filter, here we go. Okay, so previous week, let's have a look at all the economic data that came out. Okay, so Monday, not really interested in that. Low. Obviously RBA minutes that came out. Aussie Conference Board overall economic data comes out better than expected. Nothing really there. Previous week, okay, job data slightly worse than forecast. Consumer confidence came in weak. House prices more or less in line, potentially lower. Business confidence data, Westpac, this is all low, medium. Okay, loans, not really interested in that. Obviously employment data very weak. Okay, not exactly spectacular. I mean, although the unemployment rate certainly pushed higher, the employment rate or the change in jobs obviously lower. Okay, nothing really of any significance except the employment numbers that came out. Okay, so you had the economic data overall good, 1.3%, 0.1, 1.5. So overall the economic data is certainly looking as if it's coming in slightly better than expected. So the actual rate cut from Australia certainly has come into question. That's basically the summation really. The economic data really is coming into question, and the whole reason why they did the rate cut, not because of the economic data being forcing their hand, it was more to do with fighting off deflation. As we all know, there's a global war on deflation, and there's a currency war as well, and nobody wants to import that deflation that's been exported by, obviously we all know who. Okay, so that's certainly a trick that every central bank is or a game that every central bank is trying to play. So was the interest rate cut more to do with domestic growth being weak, or was it more to do with international currency wars? Okay. And also give with regards to the commodities obviously hurting the currency to a certain extent, or was it to do more to do with regards to obviously fighting the currency war and maintaining a lower currency? So that's the question that a lot of individuals have stated, and that's why the minutes that came out were not as dovish as everybody expected. So the summation really from here is, number one, the Aussie data is indicating that we may well, provided the Aussie data comes in stronger this week, is indicating the Aussie may well rise, which in turn is moving with commodities. There's a potential for commodities to rise, okay, and obviously there's a potential for the dollar to fall, provided obviously the FOMC minutes dictate and everybody maintains a dovish stance, and Mr. Yellen obviously plays the correct cards, okay. Even if she's neutral to stroke bearish, then obviously that will help the Aussie USD move higher. So just based on a technical position and presuming that everything remains dovish from the US dollar side of the equation, okay, and we don't get any geopolitical or socio-economic events, then we can see the Aussie moving higher. So now let's study the Aussie from a technical perspective, and let's see exactly what's happening here. Okay, so I always start with the Aussie USD. This is basically what I'm attempting to do. Let's go to a daily chart. Okay, so a daily chart we have here is we've broken out the downward sloping wedge pattern, which again indicates potential bullish move. We've put in a few bottoming tails, and we are starting to thrust higher, obviously given the FOMC situation. If you look at the 4-hour chart, based on the daily chart no longer making lower lows, if you look at the 4-hour chart, you can clearly see here that we have a potential reversal brewing, okay. We had this inverted head and shoulders pattern, which again is still alive, okay, and the inverted head and shoulders target being 0.8030. Now this can only occur, like I said before and like I said last time, this can only occur if the Miss Yellen obviously toes the line that the markets, or she holds, she talks up the patient rhetoric about her being patient, and if she still emphasizes and stresses international development, that means that she is certainly in the dovish camp and she's on hold, okay, and that obviously will propel the dollar lower and will propel the Aussie higher, okay. Right, okay, right. 4-hour chart, again, very bullish from the Aussie perspective. Once we break out this resistance here at 0.7860, then the next target from my perspective is the IHS target, which I've already declared at 0.8030, and then we've got the 200 MA as well. Okay, that's basically what I'm focusing on. Now let's go look at the 60-minute chart now. Okay, 60-minute chart somewhat overbought from my perspective. As you can see, we're testing the lofty heights there. Here we go. Okay, so testing the lofty heights. We've negated this bearish engulfing candle, which is a good sign, and we're consolidating at the highs. So this is going to be a very interesting chart. Okay, so this is your diagonal trend line here. Okay, and realistically you're looking at those resistance levels there, and obviously your double top resistance at 0.785. Given the fact that you have the situation in Turkey, I think that will obviously create a potential risk-off scenario. The Ukraine situation, potential risk-off scenario, and the Greece situation, again, that's going to be open to the equation. Now, if bear this in mind, whenever the euro rallies, then obviously the Aussie and the Kiwi tend to move in tandem. Okay, so if we have a 4-month extension and the can has truly been kicked down the road, also with regards to the Troika and the EU-Euro group authorizing the bill and the movement in the Euro USD is going to be very, very important. So if Greece comes up with some sort of solution or resolution or their plans, as we all know, given the media reporting over the weekend, if they come up with some a plan that's sanctioned and authorized by the EU on Tuesday and or Monday and Tuesday, then that obviously will send the euro higher, which in turn sends the Aussie and the Kiwi higher as well, and obviously sterling and the dollar generally tends to sell off, given the fact that the Greece situation is out of the way. If we do get good news out of Ukraine and Russia, again, that will cause a dollar to fall, and that inadvertently helps risk, which lifts the Aussie as well. Okay, so looking at it from not a long term, but just from a fundamental perspective. Okay, so from somewhat into resistance at present. Okay, so again, Greece will dictate, Russia, Ukraine will dictate, and we'll see exactly what occurs there. Again, into resistance, as you can see, horizontal resistance is basically where we are. Given the Greece deal, etc., that came out, obviously that helped risk, and as you know, the dollar was starting to fall. Hence the reason why the Aussie ended up in the highs. Okay, so that's basically where we are. It's all about the 4-hour chart, which is the inverted head and shoulders formation, folks. Once we break that 0.785060 region, off we go to the races. The first obviously level will be the 200 MA, then eventually the IHS formation. So overall, Aussie is bullish, but is dependent upon strong or no longer, well, basic number one, strong economic data out of Aussie. So any or bullish commentary from the Aussie's perspective, i.e. China, stronger news out of China, the Shanghai, Hang Seng need to keep moving higher, Nikkei needs to move higher. No geopolitical obviously standoff or any news flow that's negative for the markets, which obviously that will cause a bid in just CHF, JPY and the US dollar. Okay, so all these conditions must be met, and then you should have a rally in the Aussie, and Miss Yellen will be the key. Also Eurogroup meeting will be the key as well, and overall it's about risk. Okay, it's all about risk, and provided we don't have any scares from the Aussie's perspective, so any rhetoric about talking the Aussie down, again, it can always remain vulnerable to that. Okay, always remain vulnerable to that. Also, the economic data out of Europe needs to be continue to come in strong. We have business climate data and current assessment and expectations out of Germany. We have CBI sales out of the UK. So again, if they're strong, everything should be good. Okay, and the US data can't be over. Well, basically, from the outset, I think on Monday we have weekly consumer confidence data out of Australia. Then we have some economic job reports on Tuesday. Then we've got German government spending and private consumption, so very important data out of Germany Tuesday. So provided that remains strong, that should certainly help the Aussie and keep it well bid. Then we have the economic data from the US, which is going to be very interesting, especially the consumer confidence data and the markets PMI data out of the US, and obviously the report from Miss Yellen as well. Wednesday, anything out of there? The wage cost index. Now that's going to be very interesting for Aussie traders on a Wednesday. That will obviously give us an insight into inflation and obviously disposable income, and that generally is the key for raising interest rates or keeping interest rates stagnant. We also have the HSBC data, China PMI. That's going to be very interesting. Okay, and also consumer sentiment out of China. So China dictates or forces the Aussie to move. Obviously, oil will be very important too. Oil needs to either make a base or move higher, and the Aussie will certainly follow. Then Thursday we have private capital expenditure, which really isn't that important. What's more important is the German data. So the unemployment data out of Germany, that's going to be more important from my perspective. And that will dictate the movement in the Aussie as well. Provided we have growth, it's all about growth from the Aussie's perspective. Okay, US data out of on Thursday, jobless claims, again that will be important. Whether or not the dollar obviously continues its move higher or consolidates or moves lower. Friday, nothing. Yes, we have the private sector credit. That's not really important. So again, it's all about policymaker comments as well out of Australia. Okay, that's going to be interesting. We did have the S&P threat or the downgrade threat. Again, that's looming over the Aussie USD, but we've shaken that off. Hence the reason why you had that 4-hour bearish candle there, which again has been negated. So that's bullish news. So if anything, that adds to the short squeeze or the power of the short squeeze. So certainly take that into consideration as well. It's not necessarily negative, and it's old news as well to a large extent. It's already been priced into the market, as you can see, double bottom on the Aussie, and that certainly has to be respected. And the inverted head and shoulders formation on the technical side. Okay, folks. So I think that's a good summary with regards to the Aussie USD. Short term, certainly into potential resistance, but over the next day or two, it's all about Yellen, Eurogroup, and obviously provided there's no comments out of the RBA or Australian policymakers. But overall bias based on a technical perspective remains bullish, provided Miss Yellen behaves, and obviously we have no geopolitical event that causes a risk-off scenario. And the Greece situation certainly remains calm. Okay, risk on, risk off, wax on,